morning, market chameleons, and my favorite chameleon, Dimitri Bargamonic. How you doing, Dima?
Good morning, Will. How are you?
Awesome. So what do we got on tap for this morning?
So today we're going to continue talking about the financial statements. I'm going to do the balance sheet. So the previous couple of days, we went over the income statement, the cash flow statement, the significance of those statements. The last one we'll do is the balance sheet. This one I'm going to keep short for a couple of reasons. There's not as much to talk about, but we also coming up on a holiday weekend, and we're doing another show today at 10 a.m. with Jake. So Jake came on, he's a Market Chameleon user for a very long time. He came on just to demonstrate how to set up a particular strategy. So it's combining a stock and a call option to do a buy right. That on his first show, he put it into a paper account in Interactive Brokers. Now we're going to come back, see how that looks now, and he's going to then continue to talk about it. What do you do going forward with that trade? So that's coming up today at 10 a.m. Couple other things I just wanted before we get started on the show. We are doing an upgrade over the weekend. So while we're doing it, we're putting out a notification. We're going to take the website offline temporarily so we could do the upgrade, make sure do all our tests before we come back up, just to make sure there are no error messages coming out. So that's going to be, we picked July 4th. The markets are going to be closed. We picked very early hours where people should be, most likely sleeping or resting from 3 a.m.
You should either be getting ready for the holiday, eating hot dogs, or sleeping.
Exactly. Yeah. So try to strategically pick that day, but temporarily we're going to be offline while we upgrade the systems. All right. Having said all that, I think what we'll do is we'll start with the pre-market report just to see what's moving today in the pre-market hours. I'm going to then jump to the balance sheet, and if you have any questions, Will, let me know. And we're still allowing people, if they want to ask a question, come on and ask the question, because you think it's better asked verbally than just typing it into a chat. You could still do that. Is that correct, Will?
Yeah. So I'll put the link to the Zoom webinar we're having now. The Zoom webinar transfers over. Most people are watching it on YouTube live. So that link, you can click over to the Zoom and then ask your question live. So anyone who has a question relative to what's discussed today or any other topic about options, just come on live and ask us. So I'll put that link in the chat. I'll also put the link to Jake's webinar. You got to register for it. That will start at 10. It will also be streamed on YouTube live at 10. So you can get it in both places. But before we get started, do you want to hit the disclaimer?
Yep. So everybody, before we get started, keep in mind, Will and I and Market Chameleon, we're not registered investment advisors. We're not broker dealers. We're not telling you what to do. We're just sharing ideas. If you need professional help, call your broker. That's what they're there for, to help answer your questions and provide you with guidance. There's the disclaimer.
Excellent.
Let me share my screen. We'll get started here. So this is the pre-market report, stocks trading in the pre-market hours. We have the most active stocks, biggest percentage gainers, biggest percentage decliners. Coming down here, seeing 53 stocks made our percentage gainers list, 55 on a percentage decliners. So that's pretty mixed. It's a mixed bag. Nothing favoring a more bullish or bearish bias from that perspective. Let's take a look at the higher market cap stocks, see if anything's moving there. So I'm going to take this filter here, market cap, look for stocks $20 billion market cap or higher. 3 made the percentage gainers list, 7 on a percentage decliners list. Maybe slightly bearish, but these not a lot of stocks on the list, right? So 3 and 7, not that many stocks there. So I would still say pretty neutral at the open. If we're just looking at the movers in the pre-market hours, nothing right now is sticking out at me, really. Not a lot of volume on anything like big that I noticed. So If there are no questions on this, well, I'm going to move on to the balance sheet.
Perfect.
And I'm going to use Netflix since we've been using Netflix for the income statement and cash flow. I'll just stay with Netflix. I'm going to go here, type in Netflix in the search box. Let's go to the Netflix page, and then we'll look at their balance sheet. And hold on a sec. Hold on. Okay, here we go. So here I'm on the Netflix page. Let's click on fundamentals. Down here, we have a bunch of different reports with fundamentals. We did the income statement. We talked about the importance of that. We talked about the cash flow statement, and now we're going to do the balance sheet. So I'm clicking on the balance sheet here, and what do we want to know when we look at the balance sheet? So we talked about income statement. We're looking at the company's, sales, expenses, their profit margins. Are their sales increasing or decreasing? Are their profit margins increasing or decreasing? So we're looking at the stock's profitability, cash flow statement. We're looking at the cash flow leaving the company and coming in. So we talked about 3 different places it could come from. Their operating, from their operations, from their investments, or from their financing. Now we're going to go to the balance sheet. And when we look at the balance sheet, we're looking at the company's total assets and liabilities. That's the main takeaway from the balance sheet. And before I get into these numbers, the significance of it is when we did a estimated value for a stock, right? We were talking about like a fair value, estimated value. Usually that's based on future expectations, future earnings of a company. So if you feel good about a company, they're going to increase their sales, they're going to increase their profit margins. You kind of make an estimate, and then based on that, say, where do I think the value of the company should be today? Okay, so discounting earnings per share, dividends, whatever you want to do, whatever your model is, that's based on future expectations. So a company also has an intrinsic value, right? So maybe even if the company's not making any money, they might have assets on a book, and those assets are, if those assets exceed your liability and you liquidate the company and you sell all your assets, you pay off all your debt, well, the rest of it belongs to the shareholders. So that's like an intrinsic value of the company. That also has value, right? Not just future cash flow expectations, but what are your currently, where would your company be worth if you just liquidated everything and gave everything back to the shareholders? That's where we get the book value from, right? So if we take your assets, we subtract your liabilities, the remainder, that's equity that's owed to the shareholders. And that could be part of the valuation of a stock, okay? That's what we're looking at right now. What would be left over if, in this example, Netflix just had to stop operations, do a complete liquidation and give all the money back, whatever is left over, to the shareholders. So this is, in the beginning, this is a graphical representation, graphical view of the data table below. So I'm going to talk about the data table here. And where does this come from? It's where these numbers, they're coming from the SEC filings. Every company, public has to file with the SEC their financials. If you click on it, you can go to the financials and look at it yourself. There are annual statements and quarterly statements. In this example, I'm just going to stick to the annual statement. But if you want to do the quarterly, just switch that tab and it will reload the quarterly. So let's take a look at these numbers here. So first we have total assets. In here we see that total assets in Netflix, 39.3 billion. That's made up of current assets and non-current assets. So the difference between this is the current assets are something that you could convert to cash in the short term. If you needed to raise money really quickly, that's kind of your current assets. I think maybe the official definition is something within a year. I would say current assets, but you probably want to do it faster than that. But current assets could be cash you already have just sitting in the bank. It could be short-term notes that you could either sell really quickly in the secondary market, or they're coming up due really, really quickly. It could be inventory that you could sell quickly. It's a finished product. So those are current assets. You could also have longer term assets that you cannot easily just convert to cash, right? It could be whatever, buildings, real estate or whatever that you're using. You can't just go in there and just raise cash for it. You're already using it. It might take longer to liquidate. It could be other assets that take longer to liquidate, but nevertheless, it's an asset. So you have two types: current, non-current. If you combine both of them, those are your total assets. All right. Accounts receivable is a current asset. Maybe you sold something, you gave somebody credit, it's due at the end of the month. You're going to receive that money. That's a current asset. Okay. Then we do the same thing with total liabilities. These are debt. So you have current liabilities. These are liabilities you have to pay in the short term. And it could be, whatever it is you have, accounts payable, rent due, whatever it is. That's your current liabilities in the short term. You also have long-term liabilities, long-term debt, and so forth. You combine the two, those are your total liabilities. So if we take the total assets, subtract the total liabilities, we end up with whatever's left over for the shareholders. That's the shareholder equity. That's what, if Netflix had to shut down, sell everything, and give you back the cash, 11.1 billion. So if I come up here, we kind of could see, remember we talked about the PE ratio. That's the valuation of the company above what they earn per year. Price to sales ratio, that's the valuation of the company above their total sales. Price to book value, that's how much you're paying the valuation of the company above the liquidate book value, whatever it would be if you had to liquidate it and give it back to the shareholders. So sometimes if people's expectations for earnings are not very good, they think you're in a business that's not going to grow. They think that it's potentially, not only are you not going to grow, your revenues might go down because of competition, whatever, bad management. You're going to start seeing these valuations come closer to book value. Sometimes you'll even be below book value. So sometimes, if you're burning cash, if the expectation is you're not going to start making money in the future, and people's expectation is that things are not going to turn around and you're going to just keep burning the cash on the books, your valuation could fall below the liquidation value, right? Because all you're doing is taking that equity and using it to pay your expenses, but there's no expectation of the company going into profitability. So that's another valuation where this valuation comes from, right? Valuation ratio. How much are you above the book value? So you have two things kind of built in there, right? You have discount, what we talked about, discounting what something is worth based on its ability to generate profits, to generate income on their assets. Another one is what is its intrinsic value, basically the equity owed to shareholders. Does that make sense to people?
Yeah, D, we had a question. Is there a way that people can screen by book value?
Yeah, like price to book value. I believe you could do that from the stock screener.
Gotcha.
Let me take a look at that. And just, I'm going to come back here for a second and just talk about, total assets and total liabilities. And total liabilities, it doesn't necessarily, just even if you see it going up, is not necessarily a bad thing, because if you're borrowing money, investing it into assets that are generating you more returns than you're paying, then that could be a good thing, right? You have a good model of leveraging. So that could be part of your business model. The other thing that to look at is, well, maybe sometimes you're not generating a lot of cash. Maybe you don't have earnings, but you could have very valuable assets on the books that are non-performing. So what I mean by non-performing assets is, let's say I own a very valuable piece of real estate land, I don't know, in Manhattan, or in Silicon Valley, or, you made this investment, you're sitting on a piece of land, and the piece of land has a lot of value. But if you didn't build anything on it and you're just paying maintenance and taxes, it's not generating you any income, right? So it's actually, you're net losing money carrying it, but it could still be very valuable. It'll show up in your total assets, even though it's not adding anything to your earnings. Okay. So there are plenty of examples like that as well, where you could have bought Bitcoin, right, at a very low price. Right now, you could sell it for maybe a very high price, depending where you got in. So that's adding to your total assets, but it's not earning you anything. So it's not contributing to your earnings. That doesn't mean that's not a valuable asset that you can't convert. So there are, I would call them like non-performing assets, but they could be valuable. Okay. Does that make sense to people? And that should be part of your total valuation. When you value a stock price, you want to take a look at what we talked about before, the earnings potential. How much is this stock expected to return based on its profits, its earnings? And you want to take a look at its current, the situations, its assets and liabilities, and put that into consideration. Let me take a look at our stock screener. I think you can. So I'm on the stock screener right now. Let me just take a look at valuation ratios over here. So I clicked on this tab. We're on the valuation ratios, and I see, let me see, price to book value. So you can screen here. Let's just take a look at valuation ratios. Let me see if I could find price to book value. So let's just say, you want to look for a low ratio. You could do like below 5. So you could see here, these are the valuations based on where's the market cap of the stock divided by the total equity, to shareholders reported on the SEC filings. So you could screen it in here. So that makes, hopefully that helps answer that question.
Yeah, that's super helpful.
Okay. So if you don't have any other questions, Will.
We did have a question not related to the cash flow statement, but it was Mike, who's a long-standing chameleon from Florida. He was asking about Lennar. He's looking at a vertical put spread.
Okay.
I don't know if you could map it out for him.
What's the symbol for Lennar?
I think it's LEN.
LEN?
Yeah, he gave the
This one?
strikes.
All
Yep.
right, so I'm on Lennar, and
It's
I believe
August 6th expiration,
options
and he's
chain.
looking at the 96,101.
Okay, so right now I'm on the Lennar LEN. I'm on the options chain, and and over here we have the different expirations, and I believe you said August 6th.
Correct.
I'm going to the August 6th. And what are the legs of the spread?
It's the 101.96.
Okay, credit put spread, right?
Correct.
So 101, here's the 101 strike. This side is the puts, this side's the calls. We're talking about selling the 101 put. So here, if we're selling, I'm going to click on the bid, which is $3.20. I'm going to click on that, and that populates a theoretical sell. So selling August 6th put 101 strike for $3.20. Then we're doing another part of the second part of the strategy is buying the 96 call.
Yep.
Not 96.
No, put.
The 96 put over here down 5.7% below there, $1.65. So I'm clicking on the offer this time to generate a theoretical buy. So buying August 96 put, $1.65. I'm going to load that strategy, and this will give us a payout diagram at expiration. So this is what the payout diagram looks like at expiration. So we see right now the current price, 101.82. Since we sold the 101 put, bought the 96 put, we received theoretically $1.55 credit. This is the market, $1.55 to $2. The midpoint's $1.78. So I keep, this is important. You don't want to execute too far away from the midpoint, because the further you go away, if the midpoint of the market is kind of considered that fair market price at that moment. So the further you execute away from it, in this situation, $1.78, the more fee you're paying to the market makers to get that execution. So you could always use limit orders in between, to try to get a better price. The closer you get to $1.78, the better. The further, the worse. Here you got like 23 cents, for a credit put spread of $1.55. That's kind of significant. But let's just assume $1.55 credit. So here, there are a couple ways at expiration that it will be profitable. If the stock just sits here, or if we just sit here at 101.83 at expiration, which we have 25 business days to go, then both these puts will expire worthless because they're going to be out of the money. Stock's 101.83, it's above 101, above 96. They both expire worthless. You get to keep that credit, whatever you sold it for, $1.55. So that's what this line is here. Of course, if it goes up from here, you could see both of these will expire worthless. You keep that $1.55 credit. If it starts going down, once it gets below 101, then this put starts to become in the money. You still have a cushion of $1.55. So you could see here where your break even is, right? Subtract the $1.55 from 101. If it just crashes through, you're stopped out because you have the 96 put. So your max loss will be down here, $345 or $3.45 per, one lot. So your potential, if you want to just calculate what your potential yield is or your potential return on your money at risk, you're risking $345, but you could make $155 or $1.55 for every $3.45 at risk. You divide the two to see what your potential yield would be in 25 business days. Okay, we could go then see, well, theoretically, where do we think this spread would be priced if we just took a look at the historical stock behavior. So we're going to create a theoretical value based on historically how did the stock move. In other words, over that 25-day period, if we looked at historical data with similar situation we have today, based on how the stock moved in that period, how many times did it move higher from here? How many times did it stay here? How many times did it go down here? We could go to the distribution, theoretical value. So we see over the last 4 years, the machine looked back historically how the stock behaved. It made adjustments based on, if there are earnings, if there are no earnings, it would exclude earnings periods. It's looking at where the implied volatility is today, looking for similar situations. Based on that, the theoretical value, it's getting the average end value is $1.83. So we see it's right in between, right? So, and what if you did it theoretically at $1.55, like today's price, $1.55, that would have resulted, that this strategy would have resulted in a profit 56.5% of the time. The rest of the time, it would have been unprofitable. But again, on average, it was worth $1.83. So if you did it, sold it every time for $1.55 and had to buy back at $1.83, you would have lost on average 28 cents. So again, this is a theoretical value based on historical stock behavior. If you believe, whatever reason, that there's more potential for Lennar to go up, if you think the probabilities are tilted in more favor that it's going to climb, and you could still do that. This is just a reference of a historical stock behavior.
Since we're looking at it theoretically, Dee, could you walk us through how to look at the trade cards to see if there is one that shows up with the best theoretical potential edge?
So let me do that. So I'm going to close this if there are no questions, but if we go to the stock info, in the summary here, we have trade ideas, and these trade ideas are coming from different spread screeners we have. So we have all these different spread screeners that you could go in there, use your own filters, use your own criteria to look for a potential opportunity. We also, to get people started, we put in our own presets as starting points for things, criteria we think would be important. And then when anything hits those criteria, it creates a trade card like this. So the first three are by edge. So this happens to look, right now it's looking at the highest edge strategies, the ones that based on historical stock behavior, 3 bear call spreads came up. We could look, now again, it's not, the stock could go up. It's not based on a directional bias. It's just based on how the stock moved historically. Let's just look at, you could select any of these. I think we're looking at what bull put spread.
Yep, credit.
One bull put spread came up. It was the July 30 expiration, and it looked at the selling the 96 put, buying the 91.5 put. Right now, it's showing up as a 55-cent credit. The theoretical value we generated, based on the model, is that it's worth 46 cents. So this gives you a slight edge. And historically, at a 55-cent credit, this would have been profitable 90% of the time, hypothetical. So if you click on that, that will take you to the options chain, populate those legs for you. So take you to the options chain to that expiration, July 30th. Look over here, and it already populated those legs. So you could just kind of load the strategy and see your range of profits, right? So 55 cents credit, same thing. Here's the midpoint. Here's the stock right now, 101.82. So you could see it goes up, you'll keep that credit. You have a little bit more downside cushion, all the way down to here, right? A little bit below 96 because you're getting 55 cents. And then if it goes down, you're stop down here.
Awesome job, Dima. We're right at 9:30. It was a nice short show.
Okay.
You do a great job every day, my friend. It is really, really impressive to be a part of. Thank you so much.
Well, and thank you for the questions. That's also helpful, so we see where we could help. But here's the alert we talked about. Keep in mind, July 4th, we're gonna go offline so we can make our system upgrades. Then we're gonna come back online.
Yeah, we did have one more question. It's now too late to get to. Maybe on Monday. I know we're going to start on earnings, but Maria was asking if you can save spreads into her watch list. She was trying to do that. I'm not sure if that functionality is available, but she's going to email support. So we'll watch out for that. Dima, great job. I'll see you in half an hour with Jake. Everyone join us in half an hour. Great job.
Right. Thanks everyone for joining. Stay safe out there. Have a good trading day, and we'll see. Hopefully we'll see you later today.
Hopefully we'll see you at 10. And if not, it will be Tuesday next week. You'll see us next. Monday is a national holiday. Have a great day and weekend, everyone.